let's talk about this company, Precision Castparts, and give people a sense of why it appealed so much to Warren Buffett to begin with, why he was willing to pay a 21% premium to Friday's closing price.
Yeah, that's a great question, Eric. You know, you got to look at a couple of things here. This is a classic Berkshire Buffett acquisition. It's got pretty big margins. It's a company that makes a specialized product, which means it doesn't have a whole lot of competition. So it's got one of those moats that Buffett always looks for in a business. And then I think you really hit the nail on the head in the intro there. Buffett has been making this effort over the last many years now to build his company into something quite different than the insurance sort of stock-picking driven enterprise that he's so identified with. So if you look out over the last couple of years, he's bought BNSF Railway, he's built the energy utility business that he has. They bought a number of other more industrial type businesses and really built that part of their balance sheet.
And by moats, you mean businesses that have really no real competition or none within an arm's reach?
Yeah, that's the idea. I mean, Precision Castparts makes turbine blades, they make rivets, and my understanding is that they're not the kinds of things that an airplane manufacturer would want to skimp on. They're high quality, and there's just not a lot of competition out there for what they're making.
Now, we talked about this a bit earlier, Noah. I know you have a little more insight into it. Is the shift away from insurance on the one hand and stock picking on the other, but mostly stock picking, I would say, a result of the fact that Berkshire is just so big now, it's difficult to move the needle on the bottom line, and for that matter on the top line, without actually owning larger and larger businesses?
Yeah, absolutely. There's without a doubt. I mean, how many stocks could Warren Buffett go out and invest in and put, you know, $30 or more billion to work in? It's just not as plausible. And yeah, it's a short list. And a couple of years ago, I want to say 2 years ago, at the Berkshire annual meeting, you know, he called what he's doing right now phase 2 for Berkshire. It's this buying of operating businesses and running them for the long haul is basically a different buildup of value than what he was doing earlier in his career.
And why not use leverage here?
That's a great question. He gets asked that every year at the annual meeting. He's just resistant to it, and you know, it's surprising given how low rates are. But the other thing that has to be said is that, you know, the other operating units at Berkshire are spitting out cash, and at the end of the second quarter, he had more than $66 billion of it on the balance sheet, and you know, he's always looking for ways to spin that down.
Noah, I was looking through some Bloomberg data this morning. We've been calling it one of Berkshire's biggest deals ever, but by at least the announced value, going by the announced value, it is, unless I'm mistaken, the biggest deal Buffett has ever announced, bigger than Heinz, for example.
It sure is bigger than Heinz. The real question comes if you're going to include debt in the equation. Right. The all-in purchase price for BNSF, including debt, was a little bit bigger.
But it's up there.
And it was also a couple years ago.
However you measure it, it's either 1 or 2 or possibly 3 on the list of Berkshire's biggest acquisitions ever.
Exactly.
Now, he's still got $40 billion of cash. And you and I have talked before about how sort of quarter in, quarter out, that seems to be a number that Buffett is comfortable with. But is that because he wants the freedom and the flexibility to go after another target, perhaps even of this size, if it becomes available?
Yeah, there are two reasons. One, and this is something that he says often, is he likes to keep about $20 billion on the balance sheet because, you know, even though we've been talking about Berkshire getting away from its core insurance operations, they still underwrite a lot of risk, and there's a potential for them to have to pay out big insurance claims. So they do keep a big cash cushion always of about $20 billion for that. But then, yes, he likes to keep his options open. You see his sort of classic deal playbook is waiting for a stock to trade down or to, as we saw during the financial crisis, being able to put billions and billions of dollars to work when other people are fearful. And the reason he can do that is because he just keeps that huge cash balance around.
You know, one quick thing before we go, Noah. conglomerates typically fall out of favor, right? People begin to raise questions about whether the conglomerate structure is appropriate, if there's businesses that offer no synergy with each other. At what point is that skepticism going to be visited on Berkshire Hathaway?
I think it's going to happen the moment he's no longer around. There's just no way of avoiding that. He's done a great job at convincing people that Berkshire goes together, but the moment he's no longer there, people are going to be asking that question.